Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, November 7th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. And oh, by the way, you don't have to remain on the right side of market risk. If you're a buy-side professional and you don't remain on the right side of market risk, you're going to be selling insurance at some point. If you're a retail investor and you don't remain on the right side of market risk, you're probably going to be divorced or fired and broke at some point. So I highly recommend you respect what the market is trying to price in and participate in it. And at worst, be on the sidelines. Don't fight the market. Getting back to this executive summary, today's key macro question is, will Jay Powell spoil Donald Trump's victory celebration? Our answers are, today's Fed decision will likely include a 25 basis point rate cut, which immediately follows September's jumbo-sized 50 basis point rate cut that has triggered fears of sticky and/or accelerating inflation. Finding the appropriate words to message how the outlook for U.S. monetary policy should evolve from here will be quite difficult for our friend Jay Powell. Recall that the median FOMC policymaker sees the Fed cutting to a neutral rate of 3% by December 2026 in the September dot plot. That number feels uncomfortably stale, and the bond market has responded in kind, with the 10-year nominal treasury yield having backed up 82 basis points since its year-to-date trough on September 16th, 2 days before the aforementioned 50 basis point cut. We see the Fed maintaining its asymmetrically dovish reaction function well into 2025 until the Republican sweep policy agenda starts to impact actual U.S. inflation and labor market data. In the meantime, toning down bond market volatility will likely be its primary objective. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our client community. This one's regarding guidance. I said, Skipper, thank you for the incredible product and guidance. Thank you for the kind feedback. As a new person to your program who's significantly underweight, what is your recommendation to get to the current KISS allocation? I've been waiting for a pullback, but it appears animal spirits continue. What is your advice to getting to your tactical allocation? Thank you and God bless, and thank you and God bless for the kind feedback as well. So this question's already been answered. So as you all should be aware by now, we have made we've produced a slew of educational resources for our clients here at 42 Macro, not only to just help them, become, interpret our research better, because obviously we produce research for some of the top hedge funds, mutual funds, asset allocations funds, pension funds in the world, insurance funds in the world. Many of those are our clients, but we also have roughly half of our client base are retail investors. And so we want to make sure we're bridging the educational and sophistication gap between our most sophisticated clients and our least sophisticated clients, and those who may be earlier in their in retail investing journey. And so we produced a lot of high-end educational content to help them bridge that information asymmetry, if you will, to borrow my friend Adam Taggart's phrase. I love that phrase. So we have our macro class, 3-part macro class that's free and available to the public for anyone who wants to just become a better investor and ultimately learn how to use macro to create better outcomes in your portfolio. The macro class is not just tell you how to think about macro and listen to podcasts better. It's exactly about how to extract signal from macroeconomic information, from market data, and ultimately to sort of weaponize those insights and those signals, and again to producing better outcomes in your portfolio. So definitely check that out. I want to say it's the link there is 42macro.com/macro class, MACROCLASS. We have our KISS portfolio construction process FAQ, our discretionary risk management overlay FAQ, and then we have a glossary that explains all the different quantitative risk management tools and sort of fundamental research processes that we employ on a daily basis here for our clients 6 days a week here in terms of our Bayesian inference process. We have our product walkthroughs, our guided tour of the dashboard, customer support. So, it's a very robust system that we built here for our clients to help make them all better investors, no matter where they are on the sophistication spectrum. Getting back to this specific question here, obviously this question has been answered in our KISS portfolio construction FAQ. We have clients that are coming in and all the time, and so we want to make sure that they have an ability to go from however they're allocated, and if they're going to sort of allocate to our KISS portfolio construction process, which I highly recommend every retail investor in the world is participating in, because I highly doubt you're going to be able to generate these kinds of risk-adjusted returns on your own. But getting into to answering the question, let's just find the question, the FAQ entry that corresponds to this question. So it says, what if I'm a new member and need to get allocated to a fully invested or near fully invested KISS from scratch? So the answer here in this case FAQ, it says it is always best to dollar cost average over time when allocating significant amounts of capital to asset markets. Dollar cost averaging provides investors with the best opportunity to take advantage of price dislocations in asset markets to lower the cost basis of positions. Much like rebalancing, there is no right answer for dollar cost averaging, as much depends on the bandwidth of a particular investor might have to execute trades. The strategy that 42 Macro founder and CEO Darius employs is to buy a maximum 1,500 basis points or 15% of its portfolio of a particular position each Friday afternoon until the desired exposure is reached. For example, this strategy will build a 60% position in the SPY ETF, which is the maximum exposure in KISS for equities, from a starting point of 0% over a period of 4 weeks. If the SPY ETF declined considerably on a weekday prior to Friday, then it is appropriate to pull forward that week's 1,500 basis point purchase to that particular day. No need to wait until Friday in that particular week. He repeats this opportunistic process each week until the position is filled. So, for example, let's say you became a new client of 42 Macro. You see that the SPY, the allocation equities is 100% maxed out. It's at 100% of its maximum exposure of 60%, and you have 0% allocation of equity. So you have 5 days in that week, Monday, Tuesday, Wednesday, Thursday, Friday, to buy a 15% chunk of your portfolio to allocate that to the SPY ETF. Well, if let's say the SPY ETF is down 1 to 2% on Monday, you don't have to wait till Friday. Take advantage of the 1 to 2% down day on Monday and wash, rinse, repeat over the next 4 weeks. And again, the whole process is designed to give you an opportunity to lower your cost basis, particularly when you're in a raging bull market and it's hard to sort of catch up. And so, it doesn't necessarily mean you're going to guarantee to have a lower cost basis, because you may not have any big down days on any particular week or any other 4 weeks to take advantage of in a raging bull market. But to the extent you actually do get a correction and a pullback to take advantage of, you need to be using those opportunistically to dollar cost average and lower your cost basis. So that's how I do it personally. That's how I've observed some of the better traders and investors that I've been, that I'm blessed to be friends with, or clients, or serve them as clients. That's how a lot of what you see and what I just said is, taking the elements of what I think the best of is in terms of how they get in and out of positions. But again, that's just one way to do it. There are many other ways to do it. And ultimately, we want to make sure that you're aware of the many other ways to do it and the many other ways to implement KISS. Many clients are implementing customized versions of KISS. KISS is a 60-30-10 trend following strategy that allocates 60% assets when it's max exposure to stocks, 30% when it's max exposed to gold, and then 10% when it's max exposed to Bitcoin. Those allocations, 60-30-10, dial up or dial down over time based on our quantitative risk management tools, namely our global macro risk matrix market regime nowcasting process, which incorporates volatility targeting at the individual factor level. And then we have our volatility adjustable minimum signal to incorporate dynamic position sizing. So you have those two processes working together simultaneously to produce the actual exposure that you have in your portfolio if you're following KISS. So investors need to be aware that the reason we do what we do is because it really works. You can sort of check the performance of KISS and not only the actual absolute performance, but the risk adjusted performance, which we're even more proud of. I just don't think the average retail investor can produce these kinds of results without the quantitative risk management tools that we produce and sell here to our clients at 42 Macro. So definitely come check that out, www.42macro.com/KISS if you want to learn more about that. And if you're a sophisticated retail trader and you're sort of too busy, or you're too busy succumbing to your action bias to sit in 3 assets, stocks, gold, and Bitcoin, then you can use our discretionary risk management overlay as a market timing and position sizing guide for over 70 individual exposures across stocks, fixed income, credit, cryptocurrencies, commodities, and I think that's it, and international equities as well. So the website to check that out is www.42macro.com/Dr. Mo, DRMO. So wrap it up there. Appreciate everyone for letting me rant about that a little bit. But at the end of the day, what we're trying to do is make the world a better place by empowering people, not just on the buy side, which is what I did for most of my career, but empowering people, on Main Street as well, to take advantage of what we think is high-end institutional macro risk management process. And we're really proud of what we built, and we're really proud of our large and growing community of 42 Macro, of Team 42 investors. So everyone have a wonderful day. We'll catch you back here on Friday or tomorrow. Cheers.